Okay, welcome back investors. In this video, I'm going to be taking you through how to choose the best ETF for you. I've decided to call it the best ETF because it's always going to be relative to your specific needs, requirements, and situation. So I'm going to show you, whoever you are, whatever you're interested in, how you find the best ETF portfolio that's going to meet your needs. So if you want to know more, please like, please comment, please subscribe, help the channel get to 4,000 subscribers, and we can get the world of investing out to more people in a clear, simple, and transparent manner. Thank you to everybody that's helped us reach the 3,000 mark. It's really appreciated, and we will keep the videos coming in 2020. So first, I am on justetf.com, but before I go into how to find your ETFs, I'm going to just take it from the very beginning, from the top, and explain what an ETF is for those of you that might be new and might not know, and maybe for some of you existing subscribers as well, but also some of the key benefits of actually having an ETF, so you know actually this is going to be for me or this isn't really for me. So an ETF stands for exchange traded fund, and all that simply means is that it's a basket of different stocks or currencies or commodities that's grouped into one basket, and you can basically buy into that basket and get exposure into all of the different stocks that might encompass that specific fund. Now, one of the benefits of an ETF versus older, more traditional mutual funds is that it trades just like a stock. So historically, with mutual funds, you would be able to buy into them at the end or at the beginning of the day, whereas with an ETF, just like you would a stock, you can buy continuously throughout the day and you can know what the price is during the course of the day. Now, investors typically like ETFs for exposure. ETFs gives you the opportunity to get a broad exposure into different regions, different sectors, different asset classes, different market capitalizations, and tightly linked with that is diversification. So for some of those parameters that I just mentioned, those characteristics, you can actually diversify your portfolio. Now, there is a lot of different thoughts about how to diversify, how well you need to be diversified, etc. But what's sort of not up for debate is that if you are interested in diversification, the best and the easiest way to do that is via an ETF strategy, because through that you can diversify by market cap, diversify by asset class, diversify by region, and get exposure into whatever it is you're looking to get exposure into. If you're interested in dividends, you can get ETFs that pay you a dividend on a quarterly basis, on a monthly basis, on a half yearly basis, or you can get some ETFs that accumulate dividends for you. So in the background, they accumulate all of your dividends, reinvest it back into that ETF, and you can benefit from compounding that way. So you don't see it distributed, but you still benefit from it in a simple compounding way. ETFs is also a fantastic way for risk management. So if you want to try and manage your risks, you don't want to have, a high risky volatile portfolio full of growth stocks, etc., then ETFs is a perfect way to sort of manage that risk and to grow in line with the market and not to actually have any real volatile assets within your portfolio that could really change the direction of your performance over the course of a year or in the future. Another benefit is low cost. So now when we compare it again to older mutual funds, typically costs could be quite significant back in the day. Now ETFs range from really small costs from 0.07% upwards. Now it does depend on the type of ETF that you are going to be going for, how liquid that ETF, how broad it's tracking. But looking at the cost and finding the sweet spot in terms of cost can mean that obviously you can benefit from an ETF that's got a better performance with a much low cost. I would say one of the softer benefits as well is that it is less stress. Listen, if you take me as an example, I am an active investor. I'm what's called an active investor, which means I like to pick my own stocks. I like to pick stocks. I like to look and to research into stocks and pick specific stocks into my portfolio, companies and businesses that I want to buy into, that I want to back going forward into the future. But If you have, a very busy lifestyle, you should invest into the market, but you just don't have the time, or you don't have the patience, or you don't have the stress levels or tolerance to be picking all of your individual stocks, watching the movements, buying and selling, then an ETF is a perfect way to get that market exposure, invest like you should be investing, but not have to worry about individual stock picks. Also, there's some other benefits such as, it's secure, it's liquidity, etc, etc, and also, the fluctuations that you might see with stocks, it can kind of be a little bit more evened and bottomed out with ETFs. So if you haven't invested yet and you're thinking, where do I start, an ETF portfolio or looking at ETFs is a fantastic place to start. And if you're now wondering, how do I start and how do I pick my ETFs, that is what we're here for, and this is what we're going to talk about now. So right now, I'm on justetf.com strategy builder, and this is where you can build your own ETF strategy, which I'm going to go through now. I'm going to give you my thoughts and feelings on some of the different criteria and elements that it asks me to input my information on, and then we'll see what ETFs it comes with at the end, what type of portfolio it looks like at the end, and obviously you can then have a play around with it for yourself, as the link will be in the description. So first of all, it says let's start with an investment amount. Now, I'm going to start with an investment amount of, let's say, £20,000. That's going to be my starting amount. Obviously, it's purely hypothetical, and my ETF strategy is, I'm going to call it the less stress portfolio, because I think that's one of the real key benefits of having an ETF. So let's start. The first thing it asks us is choosing your level of risk. Now, risk is extremely important, and obviously it's one of the characteristics that I mentioned. Some stocks comes with, well, not some stocks, all stocks carry a level of risk, right? One of the ways risk is measured is by a measure called beta volatility. So if you ever pick a stock and you want to check its beta volatility, a low number means it's a less volatile stock, a high number means it's quite a volatile stock, a lot of price movements up and down throughout the course of a day, week, month, year, etc. Now, if you're going to have an amalgamation of multiple stocks, you're going to need to balance out the risk, and obviously the risk will be dependent on how much your appetite is to try and increase your returns. So risk is definitely tightly linked with return. So in this situation, I'm going to say, my ETF strategy, I'm going to be quite moderate, and I want 30% is my level of risk. I don't want that high a level of risk. You can see here where you show a simulation. So if I increase it, it shows me what my potential growth potential is, but obviously it tells me what my potential loss potential is depending on the level of risk. But I'm going to stick with 30%, because if I'm getting into an ETF, I want something that's going to nicely, moderately grow. It tells me the annualized return over the last 20 years is about 4%. 4.7% on average with this level of risk. You know what? I think 4.7 is a bit low. So 4.9 is nice. 5.1. Actually, no, 4.9. Let's go with 4.9. Let's not be greedy. So that is my level of risk. And then we're going to continue. Next, it then asks select your equity strategy. So the options it gives you is Stocks Worldwide Global Equity Strategy, Stocks Worldwide New International Economy, and there's two positions there, and Stocks Worldwide more of a regional approach. So this is looking at all of the equities within the market, some equities that are more global, some equities that are more regional in approach. So this is basically, choosing where you want your equities to kind of reside. So I'm going to go, New International Economy. That's going to be what I'm going to choose, and I'm going to select continue. Then it asks me, do I want to select commodities and have that as part of my portfolio? And you know what? I do. So I'm going to put 15% of my portfolio in commodities. Do I want gold or do I want a broad commodity basket? Me personally, I want a broad commodity basket. I don't just want to have gold. I want a bit of platinum, a bit of silver. I want to have it a bit more broad. So I'm going to select a broad commodity basket, and then I'm going to hit continue. Then it asks me, do I want to select my bond strategy? So bonds is fixed income. You can have government bonds or you can have corporate bonds. So I'm going to have a mix of government and corporate bonds, and I'm going to continue. And then it tells me that I'm done. So Here now you can see my portfolio, which basically it has 11.9% in equities within the emerging markets, 22.1% equities around the world, 21% bonds in the United Kingdom, corporate bonds with different maturity lengths, 39% bonds in the United Kingdom, government bonds with different maturity lengths, and 6% in commodities, broad market across the world. Now, when I click on show ETF selection, it asks me to sign up. So that's exactly what I'm going to do there. And I'm going to sign up. And I think, to be honest, I've already actually got an account. So let me log in. There we go. And now you can see this is basically the ETFs that is selected for me. So iShares MSCI Emerging Markets UCITS. This is a distributing ETF, which then means it distributes dividends. When we spoke about costs, the fees for this fund is 0.75%. A question that I'm often asked is, how do you charge, or how do ETFs get charged? How do you pay for your ETFs? This 0.75% is factored into the value of the fund. So think of it this way: if the fund yields £100, they will take 75p from the fund value and then distribute the rest to all of the fund holders, which would include yourself. So you don't physically see that charge, it's taken out of the value. Now, why do ETFs charge? Well, there's fund managers, there's marketing costs, there's staffing costs, there's other potential fees as well that can be endless depending on the types of ETFs and what they're investing in. So that is where the money potentially goes to when we're looking at funds. Obviously, we know the weighting and we know how much money I'm basically investing into that one. You then got iShares Core MSCI World ETF. This is an accumulating ETF. So when we talk about distributing and accumulating, distributing is when we give out the dividends to you and then you have to go and make an action off that. Accumulating is when it automatically reinvests that within inside the fund. You don't see it, but it reinvests those dividends so that it can actually build and compound there for you. We've got iShares Core GBB Corporate Bond UCITS ETF, iShares Core UK Gilts UCITS ETF, and LNG longer dated all commodities ETF. Now, one of the fantastic things you can also do on here is you can actually then say, you know what, I like this allocation, I'm happy with it, but you know what, I want to actually swap it out because I want something that's very similar to any one of these, but I want to swap it out for one that's slightly different for whatever reason. So if I click on here, you can see all of the other ones that are basically similar to this specific ETF. So it's tracking the emerging markets, but they're from different providers. Some of them are in US dollars, some of them are in UK, some of them are distributing, some of them are accumulating, etc, etc. And I might be like, you know what, 0.75%, it was a little bit too high for me. And you know what, I've heard of Invesco, even though the fund size is a little bit smaller. I like the fact that it's 0.29% and I like the fact it's accumulating. So there I can just go and swap that around and now I've got that one all taken care of. Similarly, I might do the same with the UK gilts. So I might be like, you know what, these UK gilts are, you know what, it actually only gives me two options here in Barclays. You know what, I'm going to keep it because, you know, those are the best ones. Or let's see commodities, there's not even any other ones there. Let's see bonds, there's a Barclays bond here, so I might switch from this distributing one to that, but you get the idea. You can basically do that, and that basically lets you know. Now overall your charges will be 0.17%, so that's how much of the value of the fund they'll be taking. Obviously if the fund's performing, then you know it's going to be a smaller amount relatively speaking. This is your expected return on the year, 12.31%. now if you compare that to my return last year was 6.31%. That's more than double of a return than I made last year. The only slightly difference is if I was to dollar cost average into this ETF rather than put the £20,000 up front, then I definitely wouldn't earn 12.31%, because as the fund potentially rises in value, I'm still buying at higher prices, just the way I would do with the stocks. And there's about a 5.94% level of volatility within 1 year. And then you can basically create your transactions. So what that basically shows you is all of the buy orders you can potentially do, how much shares you'll be buying, etc, etc. But really and truly, once you've got your ETFs, you can kind of just pick your broker and do that. And that's pretty much it. That shows you how to build an ETF strategy. I'm going to just do another one just to kind of try something different and see what different results come out. So let's say I'm interested in just investing 10,000, not 100. And I'm going to call this the less stress portfolio times 2, because I don't want any stress. I want to keep it completely zen. Let's start this. My level of risk, I'm willing to be a little bit more riskier. So I'm saying 80% is going to be my level of risk. And I'm going to then show my simulation. 5.2%, actually, it's not high enough for me. Let's say, why is it not changing? It should change. Oh, it is changing. Okay, 5.2% apparently. Let's come back down to 5.1. We'll stick with 5.2. Then I'm going to continue. And then I want, stocks with a regional approach, continue. I want only 5% in commodities, and I want that to only be gold. I'm going to continue. I then want, I want short-term government bonds, continue. And then it gives me, now there's a lot more ETFs here that I'm basically dealing with. I've got DECA MSCI Europe UCITS ETF, iShares MSCI Japan. I've got iShares MSCI North America, Xtrackers MSCI Emerging Markets, Xtrackers MSCI Pacific X Japan Index, Barclays 1 to 5 year gilt, and Wisdom Tree physical gold. And these are all of my allocations and my cost, and obviously 0.39%. But now my potential return for the year is 16.42%. However, there is a little bit more volatility from that standpoint. So yeah, it's a really, really neat tool. In terms of me and my strategy, I'm still continuing with my growth strategy. I have got a couple of ETFs within my current portfolio at the moment. However, in the future, if I do decide to potentially look at maybe a self-invested personal pension or something that I want for the long term, less risk, that I can just continually dollar cost average into, then I definitely won't be picking stocks for that. I would be definitely getting an ETF portfolio, and here is probably where I'd start. So yeah, the link will be in the description. Have a play around with it. If you've got any questions, definitely let me know in the comments, and hopefully you can build your perfect ETF strategy and choose the right ETFs for you. Other than that, take care, have a great evening, and last but not least, happy investing. I haven't said that for a while, haven't I? Happy investing, guys. Take care. Peace.